Welcome to Facts Not Forecasts, your daily edge in the stock market facts, insights, and opportunities you won't hear anywhere else. Today, we're plunging into, well, a pretty pivotal question for every investor right now. As AI reshapes the world, where should your money be? Is it in the fundamental hardware, the stuff powering the revolution, or the transformative software applying it? We're going to deep dive into the latest earnings from two tech titans, Broadcom, the chip giant, and Salesforce, the AI software leader. And to give us some crucial market context, we'll also bring in Ciena as our critical barometer for broader AI infrastructure sentiment.
Exactly. Our mission today is to cut through the relentless news cycle, really, and extract the most important nuggets. Financial insight, strategic insight from these companies' reports. We want to help you understand what's truly driving market movements in this, well, rapidly evolving AI landscape, deciphering not just the numbers, but what those numbers actually mean for your long-term investment strategy.
Okay, let's unpack this fascinating challenge. Starting with Broadcom, ticker AVGO. This company's been, well, an absolute rocket ship riding that AI wave to record highs. So from their Q3 2025 performance, what were the standout financial figures, the ones that really captured the story?
Yeah, Broadcom delivered a truly impressive quarter. It really reinforces their position. Their total revenue hit a record $16 billion. That's a robust 22% year-over-year increase. But here's where it gets even more telling, I think. Their adjusted EBITDA, which, basically measures core profitability before things like interest and taxes, that also reached a record $10.7 billion, up an even more impressive 30% year-over-year.
30%, wow.
Yeah. This showcases excellent operating leverage, meaning their profits are growing significantly faster than revenues. Shows how efficiently they're converting sales into bottom-line gains. For investors, this signals a well-managed business that's scaling effectively.
That strong operational efficiency is definitely a key signal. So drilling down a bit, how did those numbers break out across their individual segments? And crucially, how much of that impressive growth is directly fueled by the AI boom? Broadcom's been so central with its custom chips.
All right. Diving into the segments, their semiconductor solutions revenue that includes the AI chips came in at $9.2 billion, up a solid 26% year-over-year. Their infrastructure software segment reported slightly differently, but Q2 revenue was $6.6 billion with a Q3 outlook of $6.7 billion. So consistent, stable performance there. Now, profitability. Their Q2 consolidated gross margin was 79.4%.
Pretty high.
Very high. Breaking that down, semiconductor gross margin was around 69%, while software, as you expect from SaaS, boasted a very high 93% gross margin. But to your point about AI, that's where the real story is. Their AI semiconductor revenue surged to $5.2 billion in Q3. That's an astounding 63% year-over-year increase. And this isn't just a big number. It signals Broadcom's deeply entrenched position as a foundational layer in the AI build-out, especially given this extends an impressive run, 10 consecutive quarters of robust growth.
10 quarters.
Yeah. For investors, this suggests sustained, sticky demand for their specialized chips. Makes them a core infrastructure play, not just a speculative bet. What's more, AI networking, largely Ethernet-based, made up 40% of their AI revenue in Q2. And their XPU business, those custom AI accelerators for data centers that accelerated, it accounted for 55% of their AI revenue in Q3. Shows a clear shift towards an increasing demand for highly specialized compute.
That acceleration in their XPU business really highlights their role at the cutting edge. And their innovation, particularly with something like the Tomahawk 6 switch, seems to be pushing the envelope. But are there any emerging competitors in this high-performance networking space? Or is Broadcom's lead here fairly, insurmountable for the near term?
That's a perceptive question. Competition's always a factor, right? But the Tomahawk 6 switch positions Broadcom very strongly. It's their next-gen solution. Offers a massive 102.4 terabits per second capacity. This level of performance is absolutely crucial for deploying the kind of, massive AI accelerator clusters hyperscalers and enterprises are demanding. It's not just speed. It's handling the sheer data volumes required by modern AI.
Okay.
Management also projected a staggering customer chip opportunity. $60 billion to $90 billion by 2027. Now, that's not a guarantee, of course, but it speaks volumes about their confidence, both in their tech lead and the long-term demand for these specialized high-performance solutions.
Those are ambitious projections. Looking ahead, what kind of guidance did management provide for the coming quarter, and how did the market ultimately react to this torrent of positive news?
For Q4, Broadcom guided consolidated revenue to be approximately $15.8 billion, still up 21% year-over-year. Within that, they expect AI semiconductor revenue to hit $5.1 billion. That represents about a 60% year-over-year increase. Management expressed strong confidence that this fiscal 25 AI semi-growth rate will actually sustain into fiscal 2026. Driven by increased XPU deployment, especially for inference workloads, using the trained AI model.
Like the operational side.
Exactly. That's crucial because it implies ongoing demand beyond just the initial training phase. The market certainly liked what it heard. Broadcom stock has shown significant appreciation, up 103.66% over the last year. Recently hit an all-time high of $317.35. Analysts like Evercore ISI responded by raising price targets to $342.
That's an incredible run-up. But as we know, the market always has different perspectives. Are there any dissenting views, any potential red flags for investors to consider with a stock that's soared so high?
Absolutely. And it's important to look at those. While technical analysis often shows buy ratings, there's a strong undercurrent in community discussions suggesting the stock might be very toppy. Concerns include high Bollinger Band readings and the technical indicators suggesting it might be overbought, trading at the upper end of its range, and negative RSI divergence. That happens when the stock price hits a new high, but its momentum indicator, the RSI, doesn't follow. Often signals a potential reversal.
Okay.
These technical signals lead some to suggest a potential 20–30% correction. Furthermore, it's worth noting their debt-to-equity ratio stands at a relatively high 96.7%. While they've been working to reduce debt, for some long-term investors, this level can be a point of caution, indicates higher financial leverage. So while the growth is undeniable, his current valuation and debt levels warrant careful consideration.
So incredible growth on one hand, but some significant financial tightropes on the other. It's the classic investor's dilemma, isn't it? Chasing momentum versus weighing the risks. Now let's pivot from the foundational hardware side of AI to the software leader, Salesforce. Their Q2 2025 earnings. What's the financial picture looking like for this cloud powerhouse as it integrates AI?
Salesforce also delivered a very strong quarter. It really showcases the power of integrating AI at the application layer. They reported an EPS of $2.91. Comfortably beat forecast by 4.68%. Revenue came in at $10.25 billion, surpassed expectations, and grew 10% year over year. What's particularly fascinating here, I think, is their impressive gross profit margins, 77.34%, and a non-GAAP operating margin of 34.3%.
Right.
That non-GAAP operating margin basically shows profit from core operations, excluding some one-time or non-cash items. The fact that this marks their 10th consecutive quarter of operating margin expansion, well, it indicates consistent discipline and efficiency. It's a powerful signal of strong management and a mature, profitable business model.
That consistent margin expansion is a testament to their operational strength. Salesforce has been heavily emphasizing its agentic enterprise vision, deeply embedding AI into customer workflows. Is this strategic focus translating into tangible financial success and market share gains for them?
Absolutely, and in very concrete ways. The data cloud business, which is foundational to their AI strategy, unifying customer data, expanded by a remarkable 120% year over year.
120%.
Yeah, and their dedicated AI and data product lines' annual recurring revenue, ARR, also reached $1.2 billion, up an astonishing 120% year over year as well. Their Agentforce initiative that's embedding AI agents into workflows to automate tasks, provide insights, has seen incredible traction. Over 6,000 paid deals, 12,500 overall wins. A significant point for investors. 40% of their new Agentforce bookings this quarter came from existing customers.
Okay, so they're upselling successfully.
Exactly. Demonstrate strong expansion within their current client base, indicate successful cross-selling of these new AI capabilities.
It sounds like their existing customers are embracing these new AI capabilities with real speed, moving beyond just pilot projects to actually operationalize AI. What makes you confident they can sustain this rapid adoption across their, well, vast customer base?
That's a great observation, and the speed is indeed key. They're seeing a 60% quarter-over-quarter increase in customers moving Agentforce from pilot to production. That signals not just interest, but strong confidence and, value realization. To make adoption even easier, Salesforce introduced flexible payment options, pay-as-you-go models. With Flex credits, basically convertible credits customers can use across various Salesforce products, accounting for 80% of Q2 new bookings for Agentforce.
Ah, smart. Reduces the friction.
Exactly. Makes it much simpler for companies to test and scale their AI initiatives. They also announced the upcoming launch of their agentic IT service platform integrated directly with Slack. That further embeds AI into the very fabric of enterprise operations, boosting productivity.
That integration is key. So what's the outlook for management for the rest of the fiscal year? And how did investors react to these promising results?
Salesforce raised their fiscal year 2025 revenue guidance to between $41.1 and $41.3 billion. That represents 8.59% year-over-year nominal growth. They also increased their non-GAAP operating margin outlook to 34.1% and projected operating cash flow growth of 13%. Pretty solid outlook.
Okay. And the market?
In the market, Salesforce stock rose 1.42% in aftermarket trading. The analyst consensus is a strong buy with an average price target of $333.58. And Simply Walson indicates the company is currently trading below its estimated fair value. So that suggests potential upside for investors.
They also made a significant announcement regarding their share repurchase program, didn't they? What does a move like that signal to investors beyond just the numbers?
Indeed, they did. The board approved a substantial $20 billion expansion of their share repurchase authorization. This follows $2.6 billion already returned to shareholders in Q2, bringing the total to nearly $27 billion since the program began. A large share repurchase authorization like this signals several things, really. First, management's strong confidence in the company's financial health and future prospects.
Right.
Second, a commitment to returning capital to shareholders. And third, a belief that the stock might be undervalued, making it an attractive use of their significant cash reserves. This move, combined with over $17.4 billion in cash and short-term investments and a very healthy debt-to-equity ratio of just 13.9%, it clearly indicates exceptional financial strength and prudent capital allocation.
Okay, so we're seeing strong performance from both Broadcom on the hardware side, Salesforce on the software side, each driven by different facets of AI. To truly understand the broader market sentiment, especially the appetite for AI infrastructure, let's look at Ciena, ticker CN. What makes them a particularly relevant case study in this chips versus cloud debate?
Ciena is a network technology company. They provide hardware, software, services specifically for optical transport, sending data using light over fiber optic cables, as well as switching and data traffic management. This firmly places them in the critical AI infrastructure category. They provide the high-speed data highways connecting all those AI chips and data. Their performance offers a clear indication of how the market is viewing the underlying physical layer necessary for the AI revolution, because it's kind of pulse check.
A pulse check, right. And a notable 26% post-earnings surge for Ciena. Can you elaborate on their recent performance? What exactly drove that impressive jump?
Yeah, that surge was significant. Ciena reported Q2 2025 revenue of $1.13 billion and an EPS of 0.31 cents. Looking forward, forecasts for the full year suggest robust growth. Earnings is expected to grow 35.5% per annum, revenue by 9.2% per annum. This strong growth outlook, fueled by, insatiable demand from cloud providers and increasing AI workloads. That's a key driver for the significant investor optimism we're seeing in AI infrastructure. It shows the market is very much betting on the continued build-out of the underlying network that AI relies upon.
So Ciena surge clearly indicates strong market appetite for AI infrastructure. But what are the different market perspectives on Ciena, and by extension, on this crucial AI infrastructure segment? Is it all smooth sailing?
It's definitely a tale of two narratives. On the optimistic side, you have analysts highlighting strong demand for advanced optical infrastructure and data connectivity. That's driving Ciena's revenue, expanding market opportunities. Their WaveLogic 6 Extreme technology, for instance, is seen as a crucial technological leadership component. Enables higher capacity, more efficiency for AI clusters. This view emphasizes tech leadership, diversification as key strengths. Suggests Ciena is well positioned for increasing AI data traffic.
Okay, that's the bull case.
Right. But then there's the cautious view. Concerns include potential for slowing growth, maybe due to market saturation in some legacy areas. The risk of margin erosion from hardware commoditization, where hardware becomes sort of a generic product sold mainly on price. And dependence on a few very large customers, which can introduce volatility. Geopolitical risks, supply chain uncertainty are also noted as potential headwinds. What's fascinating here is that despite these caveats, and despite its high price-to-earnings ratio of 127.9x, way higher than the industry average of 25.7x.
Yeah, that's steep.
Ciena's stock still surged. This reflects the market's strong appetite for companies providing the foundational hardware for AI, even when valuations appear stretched. Interestingly, while expensive, Simply Walson indicates Ciena is trading slightly below its estimated fair value. So the market seems to be pricing in future growth very aggressively.
That's a really insightful look at how the market's weighing opportunity against risk in the AI infrastructure space. Now that we've deep dived into Broadcom and Salesforce and understood the broader infrastructure sentiment with Ciena, let's put it all together. For long-term investors, which stock looks stronger post-earnings? What are the key differences we should consider?
This is where it gets really interesting, right? Looking at the two distinct ways to play the AI revolution. Let's compare them across a few critical dimensions for investors. First, growth drivers. Broadcom's a semiconductor powerhouse, directly benefiting from massive demand for AI chips, networking, huge organic growth specifically in AI hardware. Salesforce, on the other hand, software leader, transforming its platform with AI-driven agentic enterprise solutions. Strong growth in areas like data cloud, Agentforce, by enhancing enterprise productivity.
Okay, different engines.
Exactly. Then recent performance. Broadcom's Q3 revenue growth was 22% year over year. Its AI semi-segment surged an incredible 63% year over year. Salesforce's Q2 revenue growth was 10% year over year, but its specific data cloud and AI ARR grew an astonishing 120% year over year. So Broadcom shows higher overall company growth rate, but Salesforce boasts higher specific AI segment growth. Highlights its success integrating AI into software.
Interesting distinction.
For profitability, both companies show strong margins. Broadcom's Q2 consolidated gross margin was 79.4%. Salesforce reported Q2 gross profit margin of 77.34%, and that consistently expanding non-GAAP operating margin of 34.3%, both highly profitable. Looking at balance sheets, Salesforce presents really very strong financial health, more cash than debt, remarkably low debt to equity of 13.9%. Broadcom's debt-to-equity is significantly higher at 96.7%, though, as we said, they are actively working to reduce it. Still, a key difference for risk-focused investors.
Right, that leverage.
Exactly. Finally, valuation and market reaction. Broadcom's had that huge run-up over 103% in the year. Some analysts' community discussions suggest it might be very toppy, implying maybe limited upside at the current price. Salesforce, while also performing well, 1.42% post-earnings bump, strong buy ratings is indicated by analyses like Simply Walsand to be trading below its estimated fair value, potentially suggesting more upside from a valuation perspective.
That's a comprehensive breakdown. So, considering all these facts, the growth, profitability, differing balance sheets, market sentiment, what's a balanced outlook for long-term investors trying to navigate these two powerful players in the AI space?
It truly depends on an investor-specific strategy and their risk tolerance. Broadcom continues to be a direct, potent beneficiary of the foundational AI infrastructure build-out. Its strong organic growth, commanding position in custom AI ASICs, networking, incredibly compelling. However, its high current valuation, that debt level, they warrant careful consideration. And the sustainability of its rapid AI growth, especially as competitors emerge and the market matures, that's a key question analysts are asking. Salesforce, on the other hand, presents a picture of a mature SaaS company, successfully integrating AI to drive new value, new efficiency for enterprises. Its strong financial health, consistent profitability, strategic investments in AI like Agentforce and Data Cloud, they offer a stable, long-term growth story. Potential for further market share gains as businesses undergo this agentic transformation. And that increased share repurchase authorization indicates significant confidence, commitment to shareholder returns. That can appeal to more conservative growth investors.
Okay.
Overall, the market appears to be rewarding both the foundational infrastructure, as we saw with Ciena's sentiment, and the application layer of AI. The choice ultimately depends on an investor's appetite for risk, their preference for hardware-driven versus software-driven growth within this evolving AI ecosystem. Both offer compelling narratives, but with different risk-reward profiles. This deep dive truly reveals that while AI is driving incredible growth across the tech sector, its impact manifests in fundamentally different ways. From the fundamental chips and networking gear enabling the revolution, to the transformative enterprise software platforms defining its application.
It raises an important question for all of us as investors, doesn't it? As companies rush to become agentic enterprises and build out their AI infrastructure, how will the long-term balance of power shift between the hardware providers enabling the AI revolution and the software innovators defining its application? Will the market continue to equally reward both? Or will one segment eventually outpace the other in sustained profitability and growth over, say, the next decade? Appreciate you tuning in. Until next time, stay sharp, stay patient, and let the market work for you.